Okay, so next we are going to read an illustrative case, okay, from the textbook. Okay, so if you have the textbook, you can read from your textbook. Otherwise, I will cut here. Okay, this is a case for the fraud of triple Z based company. Okay, two parts. Okay, I think you read it. You read it first. Okay, where is the area you have to pay more attention to? This is in the process of you are in the process of obtaining a new client. If this is your new client, what should you do, or what should you pay more attention to? The boss is 16 years old. Yeah, the boss is 16 years old, a high school student. I think that is not a problem. The age is not a problem. Okay, and then although the company experienced significant growth, that is the problem, right? That is the area we have to pay attention to. The boss is quite young, and the company is experiencing a significant growth. Okay, but the boss think that's not fast enough, so he's quite aggressive. Right, quite aggressive. And he hired several officers with criminal records. That already is a problem. Criminal records. And conceived a plan to restore damaged buildings for insurance companies. Yeah, we all know many things about pretend something and then claim for the insurance, right? And a number of multi-million-dollar restoration contracts were supposedly undertaken that later were found to be completely fictitious. Okay, so the integrity of the management. Okay, and then the next page. Cover up, right? Okay, cover up the scheme by spending several $1 million to lease a building and make it appear to be a legitimate restoration project when the CPAs insisted upon visiting the site. That is the required auditing procedure to visit the site. Okay, so, but the young man leased a building and restored it to show the auditors. Okay, so that is the what? Illegal act. That is a fraud. Yes. Okay. And prior to the time the fraud was uncovered, the company's stock had a market value in excess of 211 million. That's quite a lot. Shortly thereafter, the stock was worthless. Okay. So what did you see? So what will you consider in obtaining a new client? And this case clearly illustrates the risk involved in accepting a young company with a rapid growth, young and rapid. That's quite conflict. Okay, and the need to investigate the background of key officers of this company, because the young people hired many I think managers with criminal records. Okay, and the need to understand the client's operations and industries. Okay. Okay. Okay, so we will move on to the next learning objective. Okay, that's because we already obtained our client, then we are going to plan the audit. Okay, and this is a diagram from our textbook. Okay, And as you recall that we have 6 steps or 6 stages of an audit plan. Let's talk about the first 3 because they are the focus of this chapter. The first stage is to plan the audit. Okay, so at this stage, what should be done? There. Establish an understanding with the client as to the nature of the engagement. And the auditors have to develop an audit with the strategies, with the plan, with the audit program. Okay, let's talk about the plan the audit first, and then we'll come back. Okay, see. And the planning will include 3 key parts. Okay, the first part is to determine the analytical procedures to be applied. You all know analytical procedures at this moment, right? Yes. Okay. And the second thing is to set up the level of materiality. And the last one is to see if you should hire a specialist. If you are not familiar with that industry, maybe a specialist is required. And the auditors use a risk-based approach in which they are continually considering the possibility of material financial misstatements. So if this client is an old client, the planning is finished right before the auditing is started. If that is an old client, but if this is a new client, this process is an ongoing process because they keep considering the possibility of material financial misstatements. So they might revise the audit plan from time to time during the audit. Okay. If this is an old client, all the required understanding was documented in the working papers. You can read the working papers and compare this year's audit plan. But if it's new, then you have to do this to consider the possibility of the misstatements, material financial statement misstatements. So once you consider the possibility is high, you will revise your audit plan. Okay, so that is called a risk-based approach. Okay, then let's talk about what is materiality. What is materiality? You have to find the definition from the financial standards. Okay, I can show you. Okay. According to Phase B Statement of Financial Accounting Concept number 8, okay, the omission over misstatement of an item in a financial report is material if, in light of surrounding circumstances, the magnitude of the item is such that it's probable that the judgment of a reasonable person relying upon the report would have been changed or influenced the inclusion or correction of the item. Okay, and we also have one from the AICPA. I think AICPA is more friendly. Okay, AICPA AU-C 320 indicates that misstatements, including omissions, are material if there is a substantial likelihood that individually or in the aggregate, they reasonably would influence the judgment made by a reasonable user based on the financial statement. Okay, so if you are a reasonable person and you will make decision based upon the amount provided by the financial statement, and that amount will influence your decision, then that amount is material. Yeah. I think AICPA's definition is more reader friendly. It's easier to be understood. Okay, so can you use your own word to explain to provide the definition for materiality as yourself, yeah. If that amount will influence your decision and you are a reasonable person, then that amount is material. Okay, an increase in the amount of materiality would result in a decrease in the scope of audit procedures. So the higher the materiality, the lower or the higher, the lower, right? The depth in the scope of audit procedures, right? If you said if your acceptable materiality is quite high, then you don't have to perform so many analytical procedures or so many or collect more evidence. So understand? Yeah, but if your materiality is set as a low level, that means you have to collect a lot of evidence to support the auditing. This is materiality, and we also have a rules of thumb for materiality. So you can take 5% to 10% of net income before taxes, set as materiality, okay? Or you can choose 0.5% to 1% of total asset, okay? And 0.5% to 1% of total revenues, or the last one is 1% of total equity. You can set your materiality level based upon these rules of thumb. Okay. Okay, and we have a materiality and we also have a performance materiality. So what is performance materiality? Please remember the materiality you set is an aggregate amount. The combination of the material misstatements together should not exceed the materiality you set. So that is the aggregate number. But what if there are many, like you are auditing the inventory. If you found two mistakes or two errors together, these two errors, if you set the materiality at let's say $10,000, okay, and you find two errors in the inventory. One is 6,000 and the other one is 5,000. Together they are 11,000, right? But your materiality is set as 10,000. If you view that separately, no problem, right? Because one is 5, the other one is 60. Is 6. They all below 10,000, right? But together, 5 plus 6 will make 11. And that 11 will exceed your materiality, which is 10. So that is the problem. And performance materiality, the concept was proposed to avoid this problem, okay? So that is called the performance materiality. So you will set a materiality label, and you also will set a performance materiality label. And that number will be lower than the materiality to avoid the aggregation problem. Okay. What does that say? This concept was introduced to reduce the possibility that the aggregate of uncorrected and undetected immaterial misstatements in the financial statement would exceed overall financial statement materiality, which is 10, right? And therefore, the auditor would establish performance material at an amount less than materiality for the financial statement as a whole. Okay, so we have a materiality and then we have a performance materiality. We also have a tolerable materiality. Okay. Tolerable misstatement, okay, or materiality, okay. So what does that mean? A tolerable misstatement may be viewed as the application of performance materiality to a particular audit procedures. Okay, then what does that mean? It may be the same amount or lower than performance materiality depending on the audit sampling technique being used and the number of audit procedures affecting the relevant assertions. So let's go back to our example. We set the materiality to 10,000, right? And we set the performance materiality to 7, which is lower than even 10,000 materiality. And we also can set our tolerable misstatement as 7 or as 6 or at 5. You can set it 7 as the same as your your performance materiality or an amount lower than that amount. Okay. Okay. And there is a case in the textbook. That is on page 227, and it's an example of the relationships among materiality, performance materiality, and the tolerable misstatement. You can have a read. On page 227, okay, I'm right here. Okay, and this is another case, and the case is just tell you. This is another case in our textbook, and the purpose of this case is that you know that auditors often don't know enough about the complicated. For this case, this is related to currency instrument. Okay, that's the financial instrument, and most of the time, the auditors, we are all accounting background. Right? We are all accounting backgrounds for financial instruments. We are not that familiar with all the financial instruments. So at this moment, you should have a specialist in this field to assist in the auditing. Okay, because according to the research that auditors often don't know enough about the complicated financial instrument to detect such problem as indicated in this case. Okay, so just remember, during the audit, you can have a specialist to assist in your auditing. You don't have to do everything by yourself. You don't have to do the research all by yourself. For unfamiliar field, you can have a specialist. Just remember this one, okay? Because we are not expert in every field, okay? We are an expert in auditing techniques, in accounting standards, but we are not expert in every field. Okay, so this case is just that you know our limitations in this field. Okay. Okay. Yeah. So the need to have a specialist to assist in the auditing. Okay. Remember this. Okay, you can hire one. Okay, you can hire one. Okay, and then the next stage. Okay, so we finished the first step to plan the audit. So the next step is to obtain an understanding of the client and its environment. Once you decided to accept the client, then you have to proceed to the next stage to understand the client and its environment. Okay, and some risk assessment procedures used will include, I think I wanted you to see. Okay, you can research the client's industry as we just do, and the inquiries of the management, and you can perform analytical procedures. You can do observation and inspection. You can go to the client's factory or go to the client office to see, to view, or to ask. That's all you can do, okay? Okay, and once you perform the required procedures to understand the client's environment, and you should obtain an overall understanding regarding the following issues, such as the client, okay, and the client objectives and strategies of their company, and these companies related business risk, and how financial performance, okay, how financial performance is measured, and the client's internal control system. The most important part is client's internal control system. You have to get the full understanding of this part, the system, okay? And why the financial performance, how the performance is measured is important. Feel sleepy? That's why I understand, because I just want to ask you if your brain can accommodate more concept. Okay, let's finish stage 2. Okay, yeah. So why do you? Okay, so why do we think how financial performance is measured is important for understanding the client's business and its environment? Why it's important? Why do you think it's important? Okay, so baby. Okay, so do you play who's holding the baby's game last night? Last week? No, you didn't send me the photos. Okay, Asita. Okay, so why it's important? The performance measurement. Why it is important to be understood. You can link left to fraud or misstatement. If the manager's performance is based upon the sales volume, so what is the problem? They might overstate the sales, right? If the performance is based upon the sales of the company, and I will try to make the number as big as possible so that my performance will be good, right? So there is the inherent risk, right? Yes, that is why you have to understand how the financial performance for this company is measured, especially for top managers. Yeah. But overall, the internal control system is the most important. Okay. And how to evaluate client's internal control system. Okay, you can do the following to evaluate their internal control system. You can interview their personnel. Actually, this is the way when we go to the client place, we want to understand their internal control system first, because we have to set our control risk, right? Okay, and the first step, I will ask if we are doing the sales and collection cycle. We will ask the sales and ask him or her to explain the process for you. You will know the process, and then you from what they told you, you will identify the key control point. The key control point, like everybody knows that all the sales should be properly authorized, right? And for the authorization, you are going to see the signature of somebody. So to see the signature of somebody, that is a key control point. So for every voucher, you will see somebody's signature. If you don't see that signature, then there is a problem with the control system. Okay, so the first thing, you will interview their personnel. Okay, and then you can observe. You can observe for like if you are auditing the inventory, and your client personnel tell you that all their inventories were kept in the warehouse, and the warehouse is locked. and only authorized persons can get into the warehouse. So did you get it? The warehouse is locked, and only authorized persons can get into the warehouse. So these two are the key control points, right? You can go to the warehouse to see if it's locked. That is observation. Okay, you can go the warehouse and to see if the door is locked. But when you go there, you see that the door was not locked, and because it's around about noontime, you see some people are inside and have their lunchbox. So that is a problem with the control, right? Yeah, because those people are not authorized people. They cannot stay there to have their, there's no problem for them to have lunchbox. But the problem is that they are not authorized to stay inside the warehouse. Okay, so that is observation. And you can also inspect documents and reports, like you inspect the voucher to see if there is the signature of the authorized person. Okay, and you also can review prior year's working papers. As I said, if this is an old client, all those has been documented from previous. Okay, so you can review previous year's working paper, because when we went to do the auditing works, we have to document everything. We have to write down everything. Okay, and that is called working paper. So before starting the auditing works, you will review the working papers. Okay, and then you can take your working paper and compare what the personnel told you, whether they are the same. You have to update. You have to update the working papers. Maybe they have added more control points into the process. Okay, yeah. So that's all you can do to evaluate client's internal control system. So from here, you should have a very clear understanding that you should understand the client business cycles, like a sales cycle, a purchasing cycle, an inventory control cycle. You have to understand the cycle and then document the cycle, then identify the key controlling point within each cycle. And this controlling point is where you have to conduct your analytical procedures or collect evidence. Okay, so understand? Yeah. And this is very practical. I think auditing is very practical. You should do the auditing, then you will understand the theory. But when we are talking about the theory, it's kind of hard to understand. Yeah. Okay. Okay. I will stop at stage 2. Okay. And so just remember that because this data, engagement data, doesn't have a standard form. Okay, they don't have a standard form. So like from the one from the Indonesia, they can insert the fee schedule into the data. Okay, but from Mongolia, no. Yeah, so they are all acceptable. Okay, yeah. Okay, so let's finish this part and move on.